President Biden announced a student loan forgiveness plan on August 24, 2022, where borrowers may qualify for up to $10,000 or $20,000 in student loan forgiveness. More than 26 million borrowers have submitted their forgiveness application. Of these, 16 million applications have been processed and approved. The president's plan is currently on hold due to lawsuits that seek to block the president's plan. The lawsuits have been appealed. But until the courts rule on these appeals, the future of the president's plan is uncertain. In this video, we'll discuss the student loan moratorium, the restart of repayment, and some other student loan news. Hey everyone, this is Andy Hill with The College Investor, investing and personal finance for millennials. If you're new to the channel and like what you hear, please hit subscribe so you're ready when our next video comes out. Thanks. All right, let's talk about the student loan moratorium and the restart of repayment. The Biden administration has announced an 8th extension to the payment pause and interest waiver. Collection activity will also be suspended. Repayment will start 60 days after the lawsuits are resolved, or June 30th, 2023, whichever comes first. This extension means that borrowers will not have to make payments on federal student loans that have been approved for forgiveness unless the U.S. Department of Education loses its appeal of the lawsuits. Well, how about borrower defense to repayment? What's new with that? Well, if a borrower was defrauded by their college under federal or state law, the borrower's federal student loans may qualify for a borrower defense to repayment discharge. If the borrower defense to repayment claim is approved, all previous payments will be refunded to the borrower and the loans discharged, and federal student aid eligibility will be restored. There are several changes that will take effect on July 1st, 2023 and apply to all pending and new claims on or after that date. Here they are. The U.S. Department of Education may decide borrower defense to repayment claims on a group basis when a bunch of borrowers are similarly affected instead of requiring a case-by-case review of the claims. This will speed up the processing of borrower defense to repayment claims. Also, borrower defense to repayment claims may be based on an expanded set of claims categories, including substantial misrepresentation, substantial omission of fact, breach of contract, aggressive and deceptive recruitment, and judgments or final secretarial actions. The new rules adopt a preponderance of evidence standard where there must be a greater than 50% chance that the claim is true. The new regulations ban mandatory arbitration clauses and class action waivers in college contracts with students. And the new regulations require decisions to be made on claims within a certain time period, or the loans will be considered unenforceable. The new rules also establish a process for recovering the cost of borrower defense to repayment claims from the colleges. However, a lack of due process in the recovery of discharged claims from the colleges will likely be challenged in court. Previously, all of the borrower defense to repayment claims were made against colleges that had closed and weren't available to oppose the borrower defense to repayment claims. Let's jump to interest capitalization. Interest capitalization, where interest is charged on interest, will be eliminated except when required by statute. Interest capitalization will no longer occur in the following circumstances. The first time a borrower enters repayment, when a borrower leaves the pay-as-you-earn and revised pay-as-you-earn repayment plans, when a borrower is negatively amortized under income contingent repayment or an alternative repayment plan, and when a borrower enters default. Interest capitalization can increase the total interest paid over the life of the loan due to the compounding of interest, especially when the loan payments are less than the new interest that accrues. Let's jump to total and permanent disability discharge when it comes to student loans. The new regulations for total and permanent disability discharge eliminate the 3-year post-discharge monitoring period. The U.S. Government Accountability Office found that borrowers whose loans are discharged almost never earn more than the poverty line during the post-discharge monitoring period. Rather, borrowers had their discharged loans reinstated because of a failure to file the paperwork, not because their income would have been above the threshold. The new regulations expand the set of Social Security Administration determination codes that qualify for a TPD discharge. These include medical improvement possible and compassionate allowance, in addition to medical improvement not expected. Also, if the onset date of the disability, as determined by the Social Security Administration, was at least 5 years ago, the loans will qualify for an automatic TPD discharge. The new regulations also expand the types of allowable documentation and the types of healthcare professionals who can certify that a borrower is totally and permanently disabled. These include licensed nurse practitioners, physician's assistants, and clinical psychologists. Let's chat about closed school discharge. Borrowers are eligible for a closed school discharge if they were enrolled when the college closed or if they left within 180 days before the closure. The new regulations provide an automatic discharge 1 year after the college's closure date if the borrower did not accept an approved teach-out or contribute to their education at another college location. Borrowers who accepted a teach-out or continuation but who did not finish will receive a discharge 1 year after their last date of attendance. And then there's public service loan forgiveness. Some aspects of the limited PSLF waiver will be made permanent, expanding the set of qualifying payments. Here they are. It counts payments that were made late or in partial installments. It counts lump sum payments as the equivalent number of full payments. And it counts certain deferment or forbearance periods, such as the military service deferment, post-active duty deferment, deferment for active cancer treatment, economic hardship deferment, AmeriCorps and National Guard service forbearances, U.S. Department of Defense, student loan repayment program forbearance, and administrative or mandatory administrative forbearances. The new regulations establish a single standard for full-time employment at 30 hours per week. Adjunct and contingent faculty are considered to have at least 3.35 hours of work per credit hour taught. If a borrower worked for a contractor to a qualifying employer where state law prohibits direct employment by the qualifying employer, the borrower will be considered to have qualifying employment. When multiple direct loans are included in a federal direct consolidation loan, the number of qualifying payments in the consolidation loan will be the weighted average of the number of qualifying payments in the loans that are consolidated, instead of resetting the qualifying payment count to 0. And then there's the Fresh Start Initiative. About 7.5 million borrowers were in default before the pandemic. These borrowers are eligible for a fresh start when the repayment starts. The default will be removed from the borrower's credit histories, and the loans will be returned to a current status when repayment restarts. Borrowers will regain their eligibility for federal student aid. If the borrower does not choose a repayment plan and starts making payments under this repayment plan within 1 year of the restart of repayment, their loans will be returned to default status. Let's discuss bankruptcy discharge. The U.S. Department of Justice and the U.S. Department of Education announced a new policy concerning when they will and will not oppose a borrower's bankruptcy discharge petition for federal student loans. The U.S. Bankruptcy Code at 11 U.S.C. 5238A allows student loans to be discharged when repaying the student loans imposes an undue hardship on the borrower and the borrower's dependents. The Bruner test defines undue hardship as occurring when a three-pronged test is satisfied. The borrower must be unable to maintain a minimal standard of living for the borrower and the borrower's dependents while repaying the student loans. These circumstances must be expected to last for most of the loan's repayment term, and the borrower must have a good faith effort to repay the loans. The new policy is aligned with the Bruner test for bankruptcy discharge of student loans. It provides detail that illustrates each of these prongs. For the first prong, the guidance relies on the IRS collection financial standards to assess a borrower's expenses under a minimal standard of living. If these expenses exceed income, the first prong is satisfied. If they don't exceed income, but the addition of student loan payments causes the expenses to exceed income, they will consider a partial discharge. The guidance includes a rebuttal presumption for the second prong in several circumstances, such as the borrower is 65 or older, the borrower has a disability that affects income potential, the borrower has been unemployed for at least 5 of the last 10 years, the borrower did not obtain the degree for which the debt was incurred, and the loan has been in repayment for at least 10 years. For the third prong, the guidance establishes objective criteria based on the borrower's payment history and participation in income-driven repayment, in addition to the historical criteria of the debtor's efforts to obtain employment, maximize income, and minimize expenses. Signs of a good faith effort may include the following: making a payment on the loans, using deferments or forbearances such as economic hardship deferments, unemployment deferments, and general forbearances, but not in-school deferments and grace periods. Applying for income-driven repayment, applying for a federal consolidation loan, and responding to communications from a loan servicer or collection agency or otherwise engaging with them, especially with regard to payment options, deferments, and forbearances or loan consolidation. A borrower can also demonstrate a good faith effort by seeking assistance with their loans from a third party such as a credit or debt counselor. Borrowers who didn't enroll in income-driven repayment can present evidence of certain acceptable reasons, such as they were denied income-driven repayment or discouraged from using income-driven repayment, they were provided with bad information about income-driven repayment, they had a plausible belief that income-driven repayment would not meaningfully improve their financial situation, or they were unaware of income-driven repayment. These are borrowers who didn't undergo exit counseling because they dropped out of college, and they were concerned about the tax consequences of forgiveness at the end of the income-driven repayment period. This new policy should increase the number of cases where the U.S. Department of Education recommends that a borrower's federal student loans be discharged in bankruptcy. Let's chat about the new income-driven repayment plan. The Biden administration has proposed a new income-driven repayment plan that will cut the monthly amount in half for undergraduate student loans. The monthly payment of 5% of discretionary income for undergraduate student loans and 10% of discretionary income for graduate student loans. Discretionary income will be based on the amount by which adjusted gross income exceeds 225% of the poverty line. 225% of the poverty line is the equivalent of a $15 minimum wage for single borrowers. If the borrower's original loan balance was $12,000 or less, the remaining debt will be forgiven after 10 years. For all other borrowers, the remaining debt will be forgiven after 20 years. The federal government will pay any accrued but unpaid interest. This will prevent the loan balance from growing when the borrower's payment is less than the new interest that accrues. The need for annual recertification will be eliminated. Well, everyone, that's a wrap for what's new with student loans. Thanks for hanging out today. This is Andy Hill from The College Investor, and we'll see you in the next video.